Folks, it's January Fund 2026, and the market is already twitching like a man who drank too much coffee and too little sleep. The S&P 500 sits at forward multiples around 22 to 24, the Shiller CAPE pushing near 40, and the air is thick with talk of AI miracles, productivity booms, and the next great rotation. Volatility is not coming. It's already here, whispering in every earnings whisper, every Fed comment, every geopolitical headline. Most people will get crushed by it, not because the market is cruel, but because they insist on thinking forward when they should be thinking backward. Stop thinking forward. Start thinking backward. As the calendar flips to January Funds 2026, with the S&P 500 trading at forward multiples around 22-24 and the Shiller CAPE ratio hovering near 40, the market is already pulsing with the familiar rhythm of uncertainty. AI enthusiasm drives headlines, policy crosswinds loom, and volatility is not a distant threat. It is the air investors breathe. Most people will face this environment by asking the same tired question. How do I make money in all this chaos? That is precisely the wrong approach. Charlie Munger's most powerful mental model demands the opposite invert the problem. Stop chasing success. Ruthlessly map out failure first. Imagine the clarity that comes from turning the question upside down. Instead of seeking the next brilliant trade or the perfect entry point, ask the brutal, honest question, how do I guarantee I lose money, or at least underperform miserably in 2026? The answers are embarrassingly straightforward, and once you see them clearly, avoiding them becomes the easiest path to reasonable outcomes. The reliable ways to wreck yourself are not hidden. They are obvious, repeated mistakes that generations of investors have made during periods of euphoria and turbulence alike. First, chase the hottest narrative at any price. Pour capital into the latest AI darling trading at 45 dies or 50 die earnings. Convinced that endless growth will justify the premium forever. History shows that bubbles inflate on such conviction and burst on reality, right on the heads of the latecomers who bought the dream at its peak. Second, load up on leverage because volatility is temporary and margin debt feels safe in a multi-year bull run. One unexpected drop, one margin call, and the entire position evaporates overnight. Munger famously grouped leverage with liquor and ladies as the three surest paths to ruin, and the third remains the fastest. Third, sell in panic the moment the first crack appears. A missed earnings whisper, a policy tweet, a simple rotation out of mega caps triggers fear, and most bolt, locking in losses just as the cycle begins to turn. Fourth, own businesses without genuine moats. Companies that appear cheap today, but lack pricing power, network effects, scale advantages. Competitors arrive, margins collapse, and the supposed bargain becomes a slow, bleeding value trap. Fifth, trade constantly. Every flip racks up commissions, short-term taxes, and emotional exhaustion. The brokers love the activity, your net worth does not. Sixth, ignore incentives. Trust promoters, analysts, and executives pushing stories when their compensation depends on inflating the price. People act on what rewards them, on what sounds noble. Seventh, let envy drive decisions. Watch neighbors or feeds boast 3-time gains on breakouts, feel the sting, and rush to overpay or leverage to keep up. Envy is the only sin that brings no pleasure, only pain and poor judgment. By inverting the question, the path forward emerges almost automatically. Avoid these 7 traps with disciplined precision, and even average intelligence combined with patience produces surprisingly strong results. The market in 2026 will swing wildly. AI narratives will clash with reality. Policy surprises will blow through, and volatility will test every nerve. Most investors will react impulsively, chasing, panicking, borrowing, and envying their way to mediocrity or worse. The prepared mind, armed with inversion, sees the failures in advance and sidesteps them. That single shift. From seeking cleverness to systematically eliminating stupidity has quietly powered enduring success for those disciplined enough to follow it. In a year that promises turbulence, the greatest advantage is not brilliance, but the courage to look at disaster first and the resolve to never invite it in. Chasing hype at nosebleed prices is the fastest way to get wrecked. Step into January 2026, and the market is electric with the same intoxicating promise that has seduced generations, the next transformative story. AI breakthroughs dominate headlines, with leading semiconductor and infrastructure names trading at trailing multiples in the high 40s and forward estimates still painting pictures of near infinite growth. The crowd is convinced this time is truly different. Productivity gains will justify any valuation. Volatility will be tamed by endless innovation. And the only mistake is sitting on the sidelines. Yet history whispers a different truth, one Charlie Munger repeated with unrelenting clarity. Buying into the hottest narrative at peak euphoria almost always ends in disappointment and often in ruin. The pattern is painfully familiar. Enthusiasm inflates expectations far beyond reality. Investors pour capital into the sure thing at premiums that assume perfection forever, 450 times in earnings, sometimes more. Because the story feels unstoppable. Social proof amplifies the frenzy. Everyone is talking about it. Everyone seems to be winning. And the fear of missing out overrides reason. But stories are fragile. When earnings inevitably fail to match sky-high forecasts, when competition emerges, when policy shifts introduce friction, when simple mean reversion takes hold, the gap between perception and reality snaps shut violently. The latecomers, the ones who chased the peak, find themselves holding assets that plummet as sentiment reverses. The premium they paid evaporates, and the paper gains of others turn into permanent losses for them. Munger saw this cycle play out repeatedly. From railroads to comes to every speculative mania in between, and warned that bubbles are not caused by greed alone, but by collective delusion. The people who buy the dream at its most expensive moment rarely recover. They become the bag holders when reality asserts itself. In 2026 environment, where artificial intelligence enthusiasm has propelled certain sectors to valuations that would have seemed unthinkable only a few years ago, the temptation to join the parade is overwhelming. Resist it. The disciplined investor recognizes that true opportunity lies not in riding the wave of hype to its crest, But in waiting for the froth to subside and entering quality businesses at reasonable terms, chasing the narrative at nosebleed prices guarantees you arrive just in time for the fall. The market rewards patience, participation in the euphoria. Once you understand that the fastest path to destruction is buying the hottest story at its most expensive moment, the choice becomes clear: step aside, stay sober, and wait for sanity to return. That restraint, not boldness, is what separates survivors from casualties in times of volatility. Moats matter more than multiples us. As January 2026 unfolds, the S&P 500 trades at a forward peak E ratio hovering around 2224, with the Shiller CAPE ratio AO elevated near 40, levels that echo the most euphoric stretches of market history and prompt urgent questions about sustainability. AI enthusiasm has propelled leading semiconductor and infrastructure names to trailing multiples in the high 40s, fueling a narrative that growth will justify any premium. Yet Charlie Munger would cut through the noise with piercing clarity. The true measure of a worthy investment is not the headline price today, but the durability of the business's competitive fortress over decades. The classic error unfolds predictably. An investor, fixated on valuation, snaps up a stock trading at a seemingly attractive 15x or 18x earnings, convinced the discount provides a margin of safety. Upon closer examination, the company lacks meaningful barriers to competition. Margin zeroed as rivals flood in, pricing power evaporates, and returns on capital dwindle to mediocrity. That initial bargain morphs into a slow motion value trap where time quietly dismantles whatever temporary advantage existed. The multiple was never the point. The absence of a moat sealed the fate from the outset. Munger insisted that genuine economic moats, those rare structural advantages that shield profitability, are the foundation of lasting wealth. Powerful brands that command premium pricing without resistance, network effects that strengthen with every additional user, switching costs so prohibitive that customers remain locked in, patents or regulatory barriers that deter newcomers, economies of scale that deliver unassailable cost leadership. These are the true fortifications. In the AI-driven fervor of 2026, where certain leaders command lofty multiples, the critical question shifts from whether the price feels rich in the moment to whether the underlying moat is authentic and expanding. Munger frequently highlighted the Lollapalooza effect. When multiple advantages reinforce one another, the moat becomes nearly impenetrable. A company combining superior technology, massive scale, and disciplined capital allocation does not merely endure disruption. It thrives through it. Paying a fair premium for such a fortress allows high returns on capital to compound relentlessly, rendering the initial cost almost incidental over time. Ignore the moat in pursuit of a low multiple, and the investor is left defending a castle with crumbling walls. In this environment of heightened scrutiny and looming volatility, the urge to chase undervalued narratives remains intense. Resist it. Redirect attention from surface level pricing to underlying durability. Seek enterprises with real economic fortresses, those capable of raising prices without customer loss, repelling imitators, and reinvesting capital efficiently across cycles. These businesses require no bargain, bin discount to deliver exceptional long-term outcomes. The market will perpetually offer distractions, fleeting dips, overhyped tails, but the discerning investor understands that genuine opportunity resides not in buying low, but in owning excellence that time cannot erode. Once Moats eclipse multiples in priority, the logic of enduring fortunes becomes unmistakable. They are forged not on fleeting bargains, but on barriers built to last. Leverage is the silent killer, and it loves volatility. As January 2026 begins, with the S&P 500 trading at forward multiples around 2,224 and the Shiller CAPE ratio elevated near 40, the market feels invincible to many. AI enthusiasm fuels confidence, multi-year gains make borrowing seem harmless, and margin debt creeps higher as investors chase more exposure. Yet Charlie Munger issued a stark warning that echoes through every cycle. Leverage is one of the three surest paths to ruin, alongside liquor and ladies, and it remains the fastest. When markets swing, as they inevitably will this year, the margin call arrives without mercy, turning modest positions into total wipeouts overnight. The temptation is understandable. In an environment of persistent optimism, borrowing to amplify returns appears rational. A 10% move becomes 30% with 301 leverage. The upside feels irresistible. But volatility is not a one-way street. A sudden 10-15% pullback, triggered by an earnings miss, a policy shift, or simple profit taking, can erase equity and force liquidation at the worst possible moment. The investor who leveraged up in calm waters finds himself underwater when the storm hits, selling quality holdings at depressed prices to meet margin requirements. What began as a calculated bet ends as a forced exit, locking in permanent losses and emotional scars. Munger's insight was brutally pragmatic. Leverage magnifies both gains and mistakes. In good times, it creates the illusion of genius. In bad times, it exposes fragility. History is littered with examples. Margin debt spikes precede sharp corrections, and the most painful wipeouts belong to those who borrowed heavily near peaks. In 2026 uncertain landscape, where AI narratives clash with reality and policy crosswinds threaten, the risk is amplified. A single unexpected event can cascade into a deleveraging spiral that punishes the overextended far more than the cautious. The disciplined investor recognizes the asymmetry. Cash and patience preserve capital. Through turbulence, leverage demands perfection and rarely forgives error. Staying unlevered does not mean missing opportunity. It means surviving to capitalize on the next one. The market will offer plenty of chances, but it rarely spares those who borrow against tomorrow's gains. Once the seductive power of leverage is seen for what it is, a high-stakes gamble disguised as strategy, the choice becomes clear. Preserve the ability to endure, and let compounding work without the shadow of forced liquidation. In times of volatility, the greatest edge is not amplification, but the quiet strength of remaining solvent when others are not. Selling in panic guarantees you miss the recovery. As January 2026 begins, the market is already showing its teeth. The S&P 500 trading at forward multiples around 22-24, with the Shiller CAPE ratio near 40, feels stretched to many observers. AI enthusiasm has carried valuations to dizzying heights, but the first real crack. Whether a disappointing earnings whisper, a surprise policy shift, a rotation out of mega caps, simply a 10 to 15% pullback triggered by profit taking will arrive without warning. When it does, fear will flood the system. Most investors will react instinctively. They will sell. They will hit the exit button at depressed prices. A billion convinced the sky is falling, locking in losses just as the cycle prepares to turn. Charlie Munger would watch this spectacle with wary recognition and deliver the same blunt verdict. He always did. Panic selling is one of the most reliable ways to destroy wealth. The psychology is brutally simple. A sudden drop feels like confirmation of every worst case scenario. The headlines scream, correction. Social feeds fill with doomsday predictions, and the visceral pain of seeing account balances shrink triggers a primal urge to stop the bleeding. Investors convince themselves that preserving what remains is wiser than enduring further pain. They sell quality holdings, businesses with genuine moats, strong cash flows, and proven compounding ability at prices far below their intrinsic worth. In doing so, they crystallize temporary paper losses into permanent capital destruction. The cruel irony is that markets have always recovered from legitimate pullbacks. The companies that survive volatility and emerge stronger are precisely the ones that reward those who hold through the storm. Yet most cannot tolerate the discomfort. They exit at the bottom, miss the rebound, and watch from the sidelines as prices climb back to new highs, often without them. Munger understood this trap intimately. He frequently pointed out that volatility is the price of admission to long-term compounding. Great businesses do not become less valuable because the market has a bad quarter or a bad year. Their intrinsic worth, rooted in durable competitive advantages, consistent earnings power, and disciplined capital allocation, remains intact. The investor who sells in fear surrenders that compounding engine at the worst possible moment. He hands his shares to someone calmer, someone willing to endure the turbulence, often repurchases them later at significantly higher prices. The emotional cost compounds into financial cost. Studies of investor behavior consistently show that the largest permanent losses come not from market crashes themselves, but from selling at depressed levels and failing to participate in the subsequent recovery. In 2026 environment, where AI-driven optimism has inflated expectations, and any disappointment could trigger sharp reversals, the pressure to sell will be immense. A single headline about regulatory scrutiny, a slowdown in AI capex, or a rotation toward value could spark widespread liquidation. The disciplined investor resists that impulse. He recognizes that volatility is temporary, while the quality of exceptional businesses is enduring. Holding through drawdowns requires no genius, only the courage to ignore short-term noise and trust in the long-term arithmetic of compounding. The market has rewarded patience time and again. Those who stay invested in quality during periods of fear capture the full upside when sentiment inevitably improves. Selling in panic does not protect capital. It guarantees you miss the very recovery that would restore and grow it. Once the temptation to flee is reframed as the costliest mistake, the decision to remain steady becomes not just rational, but almost inevitable. In times of turbulence, the greatest act of discipline is simply refusing to run. Let envy drive your decisions, and you'll follow the crowd straight off a cliff. As January 2026 begins, your feeds are already exploding screenshots of 50%, 100%. Even 200% gains on the latest AI breakout flood every platform. NVIDIA surges again. A smaller semiconductor play doubles in days, and suddenly everyone seems to be getting rich except you. That sharp, burning sting in your chest is envy. And Charlie Munger identified it as the single most destructive force in investing. Envy does not merely cloud judgment, it systematically dismantles discipline. The moment you witness rapid windfalls, reason retreats. You abandon your circle of competence, chase unproven narratives, overpay for momentum stocks at nosebleed multiples, and justify stretching valuation because everyone else is doing it. In 2026 environment, where artificial intelligence enthusiasm has already driven certain leaders to trailing PEs as in the high 40s and forward estimates still reflect explosive growth, this behavior will be magnified. The crowd piles in, pushing prices higher, and the latecomers, driven by envy rather than analysis, become the ones left holding when sentiment inevitably reverses. Munger's antidote was brutally simple. Never let someone else's quick gain dictate your actions. He reminded us that markets are designed to separate the patient from the impulsive. The investor who envies rapid windfalls often ends up overexposed to speculative froth, forced to sell at the worst moment, when reality reasserts itself. True wealth, he argued, comes from ignoring the noise, sticking to high-quality businesses with genuine moats, and accepting that your path will look boring compared to the speculators' flashing paper profits. Social proof is powerful, but it is also a mirage that lures people into overpaying for mediocrity or outright illusion. In an era of instant gratification and endless comparison, envy feels like the default emotion. Yet, the greatest competitive advantage you can cultivate is indifference to others' short-term success. Focus on what you truly understand, buy excellence at reasonable prices, and let compounding, not comparison, do the work. The instant you stop measuring yourself against the crowd's latest winners, you reclaim control over your decisions. That quiet discipline, not the loudest gains, is what separates enduring success from fleeting excitement. Once you master this, the market's distractions lose their power, and the real opportunities, the ones built on patience and rationality, become unmistakably clear.